Well, let's get this party started. Welcome to another trading day, everybody. As you can see, I have up the May 9th research report here. And the reason I brought this up is because we're continuing to see some outperformance here. We have some follow through in the pre-market when it comes to NASDAQ futures. They're not at their highs of the pre-market session, but they are pointed nicely higher, outpacing their peer indices here. Let's see exactly what we have. Up about 0.5% there in the pre-market NAS futures. We'll see where small caps also open via the Russell. But for now, again, this is some of the follow through that we haven't been able to see in the past with respect to large moves on one particular day in the NASDAQ, but then it's just not followed up with additional gains. And it is just the pre-market, so we'll see if this actually does prove consistent with today's trades. Bonds in the pre-market before equities open also. This is about the lows of the session for the 10-year yield there, back below 1.6%. Got below that level yesterday, but finished above 1.6%. Europe, DAX was closed yesterday, reopens today, and it's basically picking up where it left off in the previous week. Continuing to tack on gains here is pretty much the rest of Europe, shy of just about unchanged there on the FTSE. Asia overnight, very strong session for the Hang Seng, up 1.75%. Kospi, nice bounce there. Nikkei, green across the board, bottom line. Oil, slight pullback here also in the price per barrel, but we'll see how this ebbs and flows throughout the trading day. Gold, precious metals, industrial metals, not much has changed there. A lot of nearly unchanged levels, copper and gold. Platinum a little bit of a bit. The dollar's under pressure once again here, and this is about the lowest level that we've seen going back to January. So we've had these bouts under $90 recently, but then we popped up above 90. But yesterday dropped back below 90 on the dollar, and here continuing to moderate that much lower. And again, this is basically the lowest level for the dollar index going back to January. Could we break through, crack through 89? Well, if you look at futures markets, that is where people are positioned, heavily short the dollar. Again, the dollar is more of a safe haven asset, and continuous rallies in equities, strong economic reopening, recovery. People just don't feel the need, to seek shelter in the dollar. But you could say the same thing as gold, and yet that one has been trending nicely higher lately. Crypto markets this morning, a bit of a pullback again here on Bitcoin, Ethereum, Litecoin there, down 4%. We'll see. I mean, these have wild swings lately, so I wouldn't take the current price at face value. So again, this is where we stand. We've got a nice bid across the board. Can we get all-time highs here yet again today in the S&P 500? Remains to be seen. But people, price action changes sentiment. It just does. If you think you're going to get anything better from the folks that come out on Bloomberg or CNBC or Fox Business News, you're sorely mistaken. Most of you remember last week, right? Jim Cramer, Mad Money. Mark Sebastian says this and that about the VIX signaling more downside for the S&P 500, right? He did the whole video on Mad Money. His go-to VIX guy, right? Mark Sebastian. You guys remember what I said last week when you sent me this article, or when it was posted in the chat box. I was like, I give a rat's behind what Mark Sebastian says. The guy has been wrong so many a time. It doesn't work for me, and I can't go by just one person's opinion just because Jim Cramer thinks of the world of the guy. in the VIX swell versus a VIX spike, discussion that he had with Mark Sebastian. The charts, as interpreted by Mark Sebastian, suggest that the next month and a half could be a pretty rough time for the market. You may think we're out of the woods, but the fear gauge says otherwise. All right, and he was basically comparing VIX spikes versus VIX swells. Since mid-April, the VIX has climbed virtually 30% from its lowest shut. I don't know what that means. The S&P 500 is down virtually 0.5% in that very same interval. A flat market with a rising VIX is exactly what you see at the beginning of what's known as a volatility swell. According to Mark Sebastian, this is when the VIX rises for an extended period of time, usually 2 to 6 weeks, and the market has a genuine correction. That was last week. That was just last week, folks. This is last night on Mad Money. Jim Cramer on why stocks could rally for the foreseeable future. You get it? You get it. You get a big one-day move in the S&P 500 by roughly 1%. You get more than almost 1.5% move in the Nasdaq, and all of a sudden, stocks could rally for the foreseeable future. We're down last week in the S&P 500 by nearly 0.5%, and all of a sudden, we got to bring out Mark Sebastian and talk about the VIX and why we could see a real correction over the next 2 to 6 weeks. And now all of a sudden today, after a nice rally on Monday, stocks could rally for the foreseeable future. Price action changes sentiment. Jim Cramer's not immune to that, human emotion and human reaction to price. He's not. Just a dude. He's just a dude. Mark Sebastian, just a dude. But I know the track record. That's why I say, don't tune him out. But over time, the more you digest, the more you remember, and the more you recollect, these folks are more often wrong than they are right. If the market is going to have a greater correction than the 4% downturn that we just had over the last 6-week period, because we've corrected more so for time than in price, given we haven't gone anywhere in 6 weeks. We just haven't gone anywhere. We made new highs, but you look at that time frame, we really haven't done anything. Go all the way back here to April. And you could basically cordon this off here, this box here. You had a new high in between, but nice 4% check back. And again, we're just, chopping around here. But if we are going to get some kind of, bigger correction, a genuine correction, something on the nature of 7 to 10%, it won't be because of what the VIX is signaling. That'll be more coincidental than causal. VIX doesn't cause anything. It's a reactionary index. It's an oscillating derivative of S&P 500 options. It's not going to cause anything. Therefore, you can't take your signal from it. Are we in a more elevated, volatility environment than we were in April? Say, yes, we are. We have moved higher, on the VIX. But again, that is not your cue. No one, index, no one indicator, no one metric is going to tell you what's going to happen next either. But again, I just think this is comical. Last week, this is where we were with Jim Cramer's sentiment. And then get one big move in the S&P 500. Now, this is where we are. The bottom line for me is, and when we see all these folks come out on CNBC, Jim Paulson of Lighthold Group, just name it. Just name the person. Everybody's calling for a correction. Scott Menard of Guggenheim just the other day. Tony Dwyer, Canaccord Genuity. Everybody, we're going to get 10 to 20% correction. It's just a matter of, we're overheated. The market doesn't have any more gas left, blah, 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 blah. I fall back to the data. Literally, just yesterday, Scott Menard, we are due for at least a 10% correction, as if the market is on some kind of punch clock. Like there's an expiration date for the market's uptrend before you get a more material correction. I go back to the data, and what the data tells us is no, you typically don't get that kind of a correction when breadth is this strong. Stocks trading above the 50-day moving average in the S&P 500. We talked about this over the weekend. Everybody, for whatever reason, seemed to miss that it happened again on April 14th. I've updated all the data with all the new calculations. The average return over 1 month after this signal fires is 1.6%. That's all good and fine. I mean, that's the average. You may not hit that average, as you can see here, and we were actually down 5% back in 2011 after the signal fired. That was during, that was basically the tail end of the European debt crisis. There's still a lot of volatility around that time frame as well. All I really care about is the probabilities. What are the probabilities that after this fires, more than 90% of stocks are above their 50-day moving average? 80% of the time, 1 month later, the market is higher. That's what I really care about. Not the average return, but are we going to be higher or not? 80% of the time, a month later, we are. 3 months later, the return is 4.6%. 91% of the time, the market is higher. And people keep wondering why we can't get this 5, 7, 10% correction on a closing basis. The breath hasn't died off enough. It just hasn't. Tony Dwyer and his airplane metaphor. You get to a certain altitude, you can't pump any more gas. The propellers can't, go any hotter. They can't spin any faster. It's a horrible, metaphor for the market. Markets don't work like an airplane. There is more juice, almost $4 trillion worth of propeller juice on the sidelines. Every time the market dips, we seem to get that much more, market inflows. We talked about that chart as well in the weekly research report. See if I can find it. I'm sure I posted it via Twitter as well. With me, bear, or bear with me. It's early, folks. You do have to bear with me. All right, here it is. From inside our weekly research report. Each time we do have a dip, look at the ETF flows, 34 billion. Bigger dip here, 35.4 billion. Really nice dip here from all-time highs, 90.5 billion. Not as big of a dip, but 42 billion. A little bit bigger dip over here, 32 billion. There's plenty of propeller juice on the sidelines, folks. And every time we do get some kind of corrective action, we see inflows, not outflows. And this is another popular narrative that folks like to go by. Looking at the NIME, the National Association of Active Investment Managers. Well, what are they doing? If they're getting out of the market, if they're deleveraging, this is their active exposure, and it fell down to 44% recently. This is updates every Thursday, right? They're getting out of the market 2 weeks in a row. I mean, that's a pretty substantial drop from 103 87, dropping 46. I mean, that's a huge deleveraging, folks. Here you can look at it by weeks. 103 down to 87, from 87 basically cut in half and then down a little bit more. After Monday's rally, what are these folks saying to themselves? Right? So, don't follow the so-called leaders. These are your hedge funds. These are your big portfolio managers. We wonder why hedge funds underperform the market as if it's their religion to do so. But again, I mean, just like that, a matter of days, this guy switches his sentiment that quickly. All right, going back to our weekly research report from May 9th. And the reason why I bring this up is because we've been talking about charts. We've been looking at relative, performance of the growth areas of the market, the semiconductors, technology, your fan mag stocks, and how they've been underperforming. But recall in this particular report, we highlighted PayPal. We compared it to the potential opportunity with Microsoft, and actually both have performed pretty darn well. They're both up almost 5% since this report on May 9th. PayPal's outperformed Microsoft by a fraction. So actually, we preferred Microsoft, but look, had you bought either one, you'd be up about 5%, in less than 30 days. But more importantly, we were looking at this chart right here. Semiconductors relative performance with the S&P 500 index ETF. So how have semiconductors performed against the benchmark? And we saw how this relative performance ratio dropped below the 200-day moving average. We talked a lot in here about, our belief that you got to be a dip buyer in semiconductors. They're in everything, and they're going to be in everything that they're not right now, which is contradictory, but you get my point. There's not going to be a near-term future that doesn't involve ever-growing semiconductor chip sales. I mean, the fundamentals there are solid. Yeah, but the supply lines, the bottlenecks, the chip shortage, that's your opportunity. That's why we are seeing the weakness in this area of the market in the relative ratio performance. It's one of the reasons. It's one of the headwinds to this. But it doesn't exonerate the long-term story for semiconductors. It just doesn't. We also looked at, if it was bad just looking at the performance against the S&P 500, it was that much worse when you look at semiconductors versus value, the value ETF. It's way below the 200-day moving average. And we looked at this chart yesterday. We set up our time frame. We go back a month basically, and here was our report. It was a weekend. Our report comes out on Sundays. So your first trading day back, and boom, it didn't get much better for the semiconductors. Got worse. And by mid-month, a few days later, on the 12th, first day back, trading is the 10th. On the 12th, it hit its bottom. It found its bottom here in the 220s. So even if you had bought here and then added here, you are sitting pretty now. And it's going to open up on the 245s. Here, maybe you started a position in the 230s, added maybe in the mid 220s. It's going to open 245 now. Let's take your average and say it's 225. From 232 to 225, you're up almost $18 a share in less than 2 weeks. This was never an official trade alert. These are the ideas that we try to generate that we think have a strong probability. We think tech is undervalued at this point. We think FanMag is undervalued at this point. We think the growth sector of the market is undervalued, and obviously semiconductors. Does this mean that they won't retreat once again? No. In fact, that should be your baseline expectation for semiconductors, that they will continue to have these bursts and pullbacks, burst of strength, then pullbacks. If they don't, good, fine, great. You're positioned for the long term anyways. But I think you got to be a buyer of semiconductor. There's got to be a place in your portfolio. I'm not big on, picking the individual semiconductor stocks. I don't need to, concern myself and fight the battles of individual chip makers, by being long an NVIDIA or an Intel or a Qualcomm. I'll get the diversification, within a sector or industry ETF. I like that play a little bit better. I think when you go after an individual company, you got to pay that much more attention to the fundamentals. It's a little bit more work. You need to read transcripts, in my opinion. You need to follow the metric performance. You need to understand, our earnings, revenues growing? Is it accelerating growth? Or is it slower growth? Like, you got to go through all of those machinations when you own individual stocks to really have an understanding and full scope of how you should position, when to take profits, when maybe to leverage higher. So, a lot to consider there. All right, some charts that I've been looking at this morning. This here is the consumer staples versus S&P 500. And basically it bottomed out in March. And we remember, consumer staples were the only sector ETF that was in negative territory on a year-to-date basis going back to March. And then had a really strong rally where it outperformed the S&P 500. And then we had another check back here. And it's been, outperforming here in May. Kind of going sideways at the moment, but is this the start of another underperformance period? Morgan Stanley out with a call where they've upgraded from underperform to equal weight consumer staples, and they actually downgraded from overweight to equal weight consumer discretionary. So I'd keep an eye on this chart. We still have some positions, within consumer staples, Walmart and Pepsi, one position on Pepsi, one position on Walmart. Given, the look of this chart here, if we get to our profit objectives for those two trades, maybe a good time to, take those profits and look to reposition given the look of this chart. Of course, this can reverse. It's, just the way it looks right now, and all of a sudden we're going higher again. You never know. Another one that I looked at, I don't want to look at the XLY, and here's why. For those of you not here in the trading room every day, like that looks just awful, right? That is putrid. Consumer discretionary versus the S&P 500 looks like a disaster du jour. But keep in mind that there's three stocks that make up basically 50% of the ETF, and that's Amazon, Tesla, and Home Depot. Just three stocks. So it's usually a better idea to look at RCD, which is the equal weight consumer discretionary. It doesn't look as bad. This is a truer, gauge of risk appetite, right? Because, when it's risk on, we tend to see consumer discretionary, outperform consumer staples, and do well, relatively speaking. Now, we have been in a downtrend, and this downtrend goes back to basically towards the middle of March here. Like, we haven't made a new high in this relative performance ratio, equal weight consumer discretionary versus the S&P 500. But being that we just made a lower low than these more recent periods, but if you go back further, we're essentially connecting some dots here in time, and I've also posted this this chart, this relative performance ratio, this morning, I believe. Yeah. So this is basically just back to where it was at the beginning or the end of February, beginning of March. And we've seen a period like this before, from December to the start of February of this year. Late December 2020 into this new year. We made new highs, but then nice check back. We created a base here and a new launch pad. And I think that's what's happening now. We have this base forming. We made new highs, just like we made new highs here. We're getting that check back, just like we're getting the check back here. I mean, it looks almost perfect, right? And look at the RSI. And it's doing the same thing right now, almost to the exact same level. This is what a trade setup looks like, folks. This is what a trade. We're getting washed out on this relative performance ratio. There might be just, one more leg down, but either way, I think you can start to position a trade here. What might you look for? Amazon. I mean, if consumer discretionary is going to come back, regardless of its equal weight or the cap weighted XLY, Amazon's going to get it done. So I think if you are of the opinion that we are basing and about to make, another U-turn here, given, the similarities between this basing period and RSI, this basing period and RSI, I think Amazon would be a good play. Some may say Tesla, because that's also a big name in consumer discretionary. Just can't, there's too much headline risk there. Too much headline risk, valuation concerns that are going to be, live in perpetuity, in my opinion. I think the safer, the more, prudent play would be a trade on Amazon there. Of course, you can always buy the sector ETF outright if you don't want to pick stocks either. But this to me is what a trade setup looks like. NASDAQ percent of stocks trading above their 50-day moving average continued higher yesterday, even if ever so slightly. We're still below 50% of NASDAQ stocks trading above their 50-day moving average. But the index itself now is, for this breadth indicator, is above that 50-day moving average. Got to get to 50% though. And that's why we need these follow-through days that I talked about earlier. You're just not going to get there with these one-off big moves, big positive performance days in the NASDAQ, and then it's followed up by a downturn. So we need consecutive, strong performance days out of the NASDAQ to get this back to that 50-day moving average. Again, this is the percent of stocks in the NASDAQ trading above their 50-day moving average. Far less in the NASDAQ than currently in the S&P 500 still. In the S&P 500, 72, almost 73%. Nice move higher in that breadth indicator as of yesterday. Above the 200-day moving average, which we complete this week, we're going to have another breadth signal fire. We talked about this one before as well. That kind of went sideways, but still above 90%. Finished above 90% last Friday. even with the downturn, and here we are, still above 90%. So what were we? What we came into the week at what? Day 54. So today will be day 55. That more than 80% of S&P 500 stocks are trading above the 200-day moving average. If we get to 61 days, we'll fire another breath. And that's essentially 2 trading months. 2 trading months where, more than 80% of S&P 500 stocks are trading above their 200-day moving average. We'll get, if we get there, which completes this week, good times, according to the historical data. Positive returns. All right, again, checking in on futures here. Europe, still looking good there, trying to get back to unchanged on the FTSE. Bond yields starting to pick up a bit here. Let's go and see what we got in the way of economic data coming out today, Tuesday. Yesterday, we didn't have anything of consequence on tap. We did send out the Morgan Stanley weekly research report here this morning. If you haven't had a chance to check it out, do so at your convenience. So from the weekend weekly research report, what do we have in the way of data? And it's a light week this week. So we have new home sales at 10 o'clock, consumer confidence also at 10 o'clock. Nothing that should be market moving. And new home sales should be very strong on a year-over-year basis. No scheduled data tomorrow. Of course, we have some Fed speakers already out this morning. So we'll see if we can catch up with any interviews with those Fed speakers. They did have an interview, I think, on Yahoo Finance yesterday with James Bullard, St. Louis Fed president. So we want to check in with him and see what his outlook is on all things, economic related. Thursday, of course, jobless claims, and we get the first revision for the Q1 GDP. First look was at 6.4% economic growth during the first quarter. And Friday, we also have durable goods and pending home sales on Thursday. So a lot of data here, but as long as initial jobless claims are holding steady, even if slightly moving to the downside, people want it to move more egregiously to the downside or more precipitous fall, but there's still some mitigating factors that are, keeping people, on the sidelines, collecting those unemployment insurance benefits, which don't run out until September. So very tight labor market right now. Wages are rising, but they're still not rising, with any grave inflationary concerns, in my opinion. And Friday, we get the PCE data that, as we talked about here yesterday, this could be something that does move the market, depending on how hot it comes in with respect to economist estimates. So this is the core inflation, the PCE core inflation gauge, which is the key gauge used by the Federal Reserve in its monetary policy, considerations. It's price stability mandate. So that could be market moving late in the week, but we won't know until we get to that point. All right, value versus growth, and where we finished yesterday, a little more downside there. Are we going to have a bigger fall? Because typically when we get these undulations, we do. Undulation down, undulation down, undulation, we'll see. You can call this an extended period of undulation, but it still resulted in that much more downside. And it seems like every time it drops below the 50-day moving average, we're just above the 50-day moving average on this relative performance ratio at present. Again, this is the value versus growth, which has been in an uptrend here since September of last year. It's been in an uptrend. Any questions? Hit me up. This is my song of the day because I heard it on the car this morning. So I wanted to play it here. I don't know if you guys remember this. The Moody Blues, Your Wildest Dreams. It's like one of my faves. This is like a slow, melodic, uplifting. In your wild. I don't know. I like it. So we're going to listen to it. All right. Any charts you guys want to look at before the market opens, just let me know. With that being said, do keep in mind we did cover or we sold. We got our execution on our position from 101.38 in the pre-market, sold at 102.40. We only have 2 positions left now on TQQQ, still on the board. And we'll look to reload. I mean, we're already fading a bit here on futures, so there might be that opportunity. The VIX is slightly bid here this morning. Still under a little pressure there on UVXY. Take a quick peek over here at the VIX futures term structure, see how we're set up. 2065, look at that. We've developed a $2.20 roll yield on VIX futures on that June future contract. Roll yield, again, is just you take the difference of the front month future contract, subtract it from the VIX itself, and you get your roll yield. 8.5% contango on that front month as well. So, maybe the VIX is, yesterday is, was typically on Mondays is typically your hedging, your weekly hedging day. And we saw the exact opposite. We saw a lot of de-hedging activity, if not outright VIX put selling, because VVIX was sharply lower as well as the VIX. But today, a little bit of, it's only a fraction, but, it does call into question if this is going to hold through the course of the trading day. We'll see. We'll see. But right now, you get a spike, up here in UVXY with that much contango and that wide of roll yield, even with 3 weeks left to go, you start positioning again. We would continue to look for 3 short positions on UVXY or VXX if we are on the cusp of another, short-term rise in volatility, rise in the VIX. Maybe we get into the 20s today on UVXY. Maybe we take a position there. Apple this morning bid up. Not at its peak, but still a bit higher here this morning. And Amazon this morning, it's bid up a good $25 there. Tesla, speaking of the NASDAQ, it did finish over 600 yesterday. It's bid up about $4 here in the pre-market as well. All right, yield curve as of yesterday stayed flat. We didn't steepen it or flatten it. It was even. We came into the week with 146 basis points. We held that as of yesterday, so no change there. High yield credit spreads shouldn't be too much. It actually moved down a little bit here from 3.42 to 3.37. So nice day in the market. Get some credit spread tightening. Again, still signals buy the dip is the play. Here's something else that I found interesting. I did a little, my own research late last night because I couldn't sleep. I had a headache. I always get a headache when I go on stage for divorce care. So last night was no different. And I take stuff, I'm preemptive, and it just doesn't work. I don't know if I get too anxious or whatnot, but anyways. Morgan Stanley, since 2009, so going back to the great financial crisis and the post-financial crisis cyclical bull market, Morgan Stanley has never held an S&P 500 price target above the average analyst estimate or modified it intra-year above the level already achieved that year. Why do I bring that up? Because this is the kind of stuff when we see what these analysts do, because Morgan Stanley just raised their S&P 500 target to 4225. But that's not for 2021. It's for 12 months. It basically takes us to June of next year. And we've already done 4225. The high of 2021 is 4238. So it's like stuff like that just irks me. It's like, that's just really screwy type of, analyst target changes. That's not analysis to me. This is like, well, how can we not go out on a limb with a price target, yet lean in favor of the price action year to date? That's what it screams to me. And that's why I went back to see. I checked all of their price targets every year, 2009, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Not once were they above the analyst average for that year. And when they did, if they did modify the price target intra-year, it was never beyond the price that had already been achieved that year. And I got no qualms about, letting Morgan Stanley know that I know kind of the schmuckery that they engage in. Like, I tweeted this right at him because it's so disingenuous in my book. It's just disingenuous. Again, I go back to, you listen to Mike Wilson, who has been pounding the table for a 10% plus correction every month, every single month since May of 2020. Like, how is their clientele ever supposed to feel like they can, add leverage to the market when their chief market strategist is calling for a 10% correction every single month? Now, more recently, they've changed their tune. They're still calling for a 10 to 20% correction, but it's based on not the price itself, it's the valuation of the S&P 500. So we're nearly at a 21 PE this week, 21 forward 12-month price to earnings estimate. So they think we're going to get a 10 to 20% de-rating of that valuation. He's given up on his price correction call, and now he's attacking valuation. So essentially, if we do get a 5 to 7% correction and earnings are still projected to be where they're going, $195 to $200 a share in EPS this year, he's going to be right. We will have a 10 to 20% de-rating of the valuation. We'll pull back to like a 20 multiple if that happens. A 20 PE. But again, okay, I was wrong about these, the last 12 correction calls I've made. So I'll try a different way to do this. That's the kind of stuff that these firms engage in. And why I say, I don't care if it's Jim Cramer. I don't care if it's Mike Wilson. I don't care if it's Jim Paulson. I don't care if it's Tony Dwyer. I don't care if it's Craig Johnson at Piper Sandler. I don't care if it's any of these guys, these former, Goldman Sachs, Will Mead, all these people that call for corrections. The data, the historic data, the quantitative data, the breadth in the market. It's what I care about. Now, breadth is not a guarantee. These historical studies are not guarantees. But what they do tell you is if we're going to get a more substantial correction, it's got to have a catalyst. There's got to be a catalyst there. It can't just be because. The propellers can't spin faster, as Tony Dwyer likes to say. You need a catalyst. And here's the other thing. We talked about this last week. We had, the Fed minutes come out. And in the Fed minutes, it was like, whoa, whoa, whoa. You got members saying that we should talk about this whole, tapering, in upcoming meetings. The market threw a really quick hissy fit there, dropped intraday when those notes came out, and then it quickly recovered. There's a message there, in my opinion, from the market that says, for all of these, daily shows and all of the people that come out on CNBC talking about, well, if the Fed does taper soon, we'll probably get that taper tantrum like we did in 2013, which, by the way, is also misinformation. And for us here at Finom Group, we'll go over that in this week's State of the Market. I'll show you what happened in 2013 versus the whole taper tantrum nonsense characterization, which is just complete false. It's completely false. And remember, how much was the market up in 2013? 30+%. That's right, 30+%. It was the in-between year of a 3 consecutive year where the market returned double digits, 2012, 2013, and 2014. Here we are, 2019, we had a 30+% return. Last year in 2020, we had about an 18% return with the dividend. And here we are up double digits year to date. This could be, no guarantees, anything can happen going forward, but this could be yet another 3-bagger, 3 years in a row where we have double-digit returns. We'll see. We'll see. But again, hearkening back to what I was saying about, man, you had one of the things that all of these different folks, strategists, analysts, portfolio managers that are marched out on CNBC talking about if the Fed signals tapering. This was as close to a message about, pulling forward the tapering conversation as we could possibly have gotten to date in last week's Fed minutes. And yet the market just shrugged it off within one trading session. The market climbs a wall of worry, and man, does the financial media like to build up that wall of worry. They don't look at market internals. I don't think they look at them to the extent that we look at them, study them, absorb them. Going back to last week, and I got emails, and that's fine. Seth, why are we adding a fourth position, to TQQQ? Isn't that breaking our rules? Rules are made to be broken. I didn't answer the emails like that. I said, part of our mandate is to be flexible. You need to have a flexible approach to the market. I don't look at it as breaking rules. I look at it as having a flexible approach and still in keeping with our, risk tolerance and overall risk management. I'll look at all the charts we just ran through. Did we make the right decision? Yes, it turns out we did make the right decision. We weren't just sitting on cash. We were buying the dip. We were flexible with our approach to the market based on the market's message that we're extrapolating on a daily basis. The market likes, the media, they love to build that wall of worry. This was a chart that we published last year, many weeks ago, months ago. And this basically shows you what the media does in perpetuity and in an increasing fashion. The average monthly tone of New York Times news content from 1945 to 2005. Higher levels indicate more optimistic tone. Higher levels. So if these are higher levels with more optimistic tone and it's trending lower, that means that there's actually getting more pessimistic as the years go by. 1979 to 2010, higher levels indicate more optimistic tone. All it's doing is going down over time. Why? Because that's all people don't click and they don't watch the positive news stories. they want to avoid losing money. So if the articles have a negative tone, they think, I gotta click on it so I can make sure I don't lose capital. Every single year that passes, the financial media gets that much more pessimistic. So what they do, they build up that wall of worry. If you're using headlines to guide your trading and it does, evoke an emotional trigger inside of you, reach out to me. Reach out to me. I'll set you straight if this chart doesn't set you straight. Now, put up the S&P 500, right? And your S&P 500 is going to go just like this, right? Across. You're going to have a big X basically in the middle of the chart. Because the S&P 500 goes from the lower left-hand corner to the upper right-hand corner over time. It dips in between, but that is the long-term trend. And this is the long-term trend of the financial media.